Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Thursday, September 7th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight we delve into Ripple's clash with the SEC and what it means for the US as a global blockchain leader. We'll explore the ambitious bid made by ARK Invest for an Ether ETF and why the SEC can't keep dodging the issue. We're also breaking down FASB's new accounting rule change, a potential game changer for institutional crypto adoption. And don't miss our take on Visa's strategic partnership with Solana, a move that could blur the lines between traditional and decentralized finance. Plus, we'll discuss Vitalik Buterin's latest venture to bring privacy and compliance together. And finally, we'll examine a lawsuit that could send shockwaves through the crypto lending space. All that and more, so stay tuned. Chris Larsen is the co-founder and current CEO of Ripple. He recently spoke about the state of cryptocurrency regulation in the US. He expressed concerns about the US losing its status as a global blockchain leader to cities like London, Singapore, and Dubai. Larsen stated that the Securities Exchange Commission lost on all key issues in the ongoing XRP case. He criticized Chair Gensler for his enforcement-first regulatory approach. Larsen noted that many crypto entrepreneurs are considering moving their operations outside the U.S. Larsen highlighted that the SEC lost on everything important in its case against Ripple. He mentioned that the SEC's request for an interlocutory appeal could extend the legal battle. Larsen also criticized the U.S. government for its hostile crypto policies, which he believes have forced crypto-related businesses to move their operations overseas. He emphasized that the U.S. screwed up on crypto and blockchain policy. Larsen's comments are a scathing indictment of the SEC and the U.S. government's approach to crypto regulation. It's a glaring spotlight on the SEC's flawed tactics. Larsen's critique of Gensler's enforcement-driven approach echoes a sentiment that many in the crypto community share. The lack of clear legislative guidelines has led to exactly what Larsen called it: regulation by enforcement, a method that stifles innovation and drives businesses away from the U.S. Larsen's observations about the U.S. losing its edge in the blockchain sector to cities like London, Singapore, and Dubai are particularly damning. These cities have managed to create a regulatory environment that not only protects consumers, but fosters innovation. The U.S., by contrast, has been pushing the industry offshore, a move that could have long-term repercussions for its technological leadership. The SEC's loss in the Ripple case is a symptom of a larger issue. The U.S. needs to rethink its approach to crypto regulation, and fast. Otherwise, it risks not only losing businesses, but also its position as a global leader in blockchain technology. The time for Congress to act is now, lest the U.S. continue to fall behind in the rapidly evolving crypto landscape. As Larsen calls out the SEC's failing crypto policies, ARK Invest is testing the waters with its Ether ETF bid. The SEC can't kick this can down the road forever. Stay tuned and don't forget to hit that subscribe button for more deep dives like this one. ARK Invest and 21 Shares have filed for the first ever U.S. exchange-traded fund that will directly invest in Ether. If approved, this ETF would be a historic milestone in the cryptocurrency investment landscape. Unlike recently proposed Ether futures ETFs, this offering would hold Ether itself. The ETF is poised to trade under the ticker symbol AKRE. The custodian of the trust would be Coinbase Custody. The SEC has yet to approve any Ether ETFs, with potential applicants hesitant due to the asset's greater price volatility and regulatory uncertainty compared to Bitcoin. James Seyfert is a Bloomberg ETF analyst. He estimates that the SEC's final deadline to approve both ARK and VanEck filings would be May 23, 2024. ARK Invest's move to file for a spot Ether ETF is a bold step in a regulatory landscape that's been anything but friendly to crypto. This is a direct investment in Ether, sidestepping the futures market entirely. The choice of Coinbase as custodian is another strategic move. Coinbase is already a trusted name in the crypto world. Its involvement lends additional credibility to the ETF. But let's not forget the SEC's historical reluctance to approve spot ETFs, especially for cryptocurrencies. The SEC has been more comfortable with futures ETFs, citing investor protections that they claim cannot be met by spot markets. ARK's filing comes at a time when the SEC is already under pressure from Grayscale. Grayscale won a lawsuit against the SEC, challenging the agency's reasoning for not approving spot ETFs. This puts the SEC in a tight spot. They can no longer hide behind vague justifications. Now, here's what I think. If ARKs ETF gets the green light, it could set a precedent for other crypto ETFs, particularly those who aim to invest directly in cryptocurrencies rather than in futures. It's a potential game changer, not just for Ether, but for the entire crypto market. And for a government and regulatory bodies often viewed as obstacles rather than facilitators, this could be a chance to change the narrative. But will they? That's the million Ether question. From one SEC hurdle to another, let's pivot to the FASB's new accounting rule. It's a shift that could grease the wheels for institutions eyeing crypto. So smash that like button if you're all for seeing big money enter the crypto world. The Financial Accounting Standards Board has made a pivotal move. Companies must now use a fair value approach for reporting their crypto assets. This rule will be effective for fiscal years starting after December 15, 2024. The final language of this new standard is expected to be approved by the end of this year. FASB, overseen by the U.S. Securities Exchange Commission, aims to make gains and losses a part of the company's quarterly income reports. The board encourages early adoption of this new standard. The rules become active in 2025, but companies can apply them earlier. Wrapped tokens are exempt. The previous accounting model was a barrier for institutions to hold crypto. It measured assets when the price went down, but not up. The new rules aim to eliminate the poor optics created by impairment losses. Companies like MicroStrategy have reported billions in cumulative impairment losses, affecting their public image. The new guidelines will not include NFTs or stablecoins. The board decided to wait for more market data before broadening the scope of the rules. The proposals were first submitted on March 23rd of this year. The FASB changed its stance as major corporations like Tesla and MicroStrategy began investing in Bitcoin. This change could fuel the next wave of corporate crypto adoption. The board's decision to allow companies to report their crypto holdings at fair market value is a big deal. It removes a significant roadblock that has deterred institutional investment in digital assets. The previous accounting rules were nothing short of a straitjacket, forcing companies to report only the downside of their investments. Now the upside can shine through, and that's a big change. Now think about it. Companies like MicroStrategy, which have been pioneers in holding Bitcoin on their balance sheets, have had to deal with the negative optics of impairment losses. These losses were a result of outdated accounting rules and did not reflect the actual value or potential of the asset. Now these companies can finally report the fair value of their holdings, capturing both the highs and the lows, giving a more accurate picture of their financial health. The exclusion of NFTs and stablecoins from the new guidelines is also noteworthy. It shows that they're proceeding with caution, waiting for the crypto market to mature further. But make no mistake, this is a step in the right direction. It's a move that could very well set the stage for broader acceptance and integration of digital assets into the mainstream financial ecosystem. But what does this mean for the community? Well, that's simple. The new rules could be the catalyst that brings more institutional players into the crypto space. And when that happens, you can bet the crypto market will not just be a playground for individual investors, but a key component of corporate financial strategies. This is the kind of change that doesn't just make headlines, it makes history. If you think the board's rule change is groundbreaking, wait till you hear about Visa's deal with Solana. It's kind of a mix of the old and the new, and it's shaking up the financial realm. Tap that notification bell so you never miss these groundbreaking stories. Visa made a strategic move by partnering with Solana for cross-border payments. The company aims to leverage Solana's high-speed, high-throughput infrastructure to meet the growing demand for stablecoin settlements. Visa has already moved millions of USDC between its partners on both Solana and Ethereum via VisaNet, its online payment processing system. The company's head of crypto is Coy Sheffield. He said Visa is committed to being at the forefront of digital currency and blockchain innovation. Visa's efforts with USDC via Solana could catalyze increased adoption in the wider crypto payments realm. The company can now send USDC-denominated payouts via the Solana blockchain to WorldPay and Nuvi. These merchant acquirers can then route these payments in USDC to the end merchants. Sheffield also mentioned that Visa plans to support additional blockchains in the future and may explore adding more stablecoins to its settlement capabilities. He said Visa's payment network will involve more than, quote, just multiple currencies and baked settlement rails, but also multiple blockchain networks, stablecoins, and CDBCs or tokenized deposits. He sees significant potential for blockchain networks and believes they share some parallels with the early internet. Visa's partnership with Solana is a clear signal that the traditional financial world is finally waking up to the disruptive potential of blockchain technology. And keep in mind, Visa processes nearly 4 out of every 10 transactions globally. The choice of Solana is particularly intriguing. Known for its speed and low transaction costs, Solana stands as a formidable competitor to Ethereum. By opting for Solana, Visa is essentially saying that it values efficiency and cost-effectiveness, traits that are often criticized in traditional banking systems. But let's not ignore the elephant in the room: central bank digital currencies. Visa is eyeing them too. Now, why would a company that's diving into decentralized technology be interested in a centralized digital currency? It's simple. Visa wants to be the bridge between the old and the new, between centralization and decentralization. It seems to me that this means that the walls are coming down. The lines between traditional and decentralized finance are blurring. And in this evolving landscape, companies like Visa are positioning themselves as the gatekeepers, the facilitators of this monumental shift. Visa's move is a win for stablecoins and a potential game changer for the wider adoption of crypto payments. Now, speaking of groundbreaking, Vitalik Buterin is back, and he's all about balancing privacy with compliance. Let's dive into this one next. And this one's our cover story for tonight. Ethereum co-founder Vitalik Buterin co-authored a research paper on a privacy protocol named Privacy Pools. The protocol aims to use zero-knowledge proofs to verify the legality of users' funds without revealing their full transaction history. The paper was co-authored with core developer Amin Soleimani, researcher Jacob Iliam from analytics firm Chainalysis, and academics Matthias Nadler and Fabian Schar. These authors describe the new platform as, quote, a novel smart contract-based privacy-enhancing protocol designed to enhance transactional privacy on blockchains. The primary goal of the project is to create a separating equilibrium. That's a system that aims to filter out funds linked to criminal activities while striving to find a balance between privacy and regulatory requirements. The paper outlines how Privacy Pools allows users to prove their crypto withdrawals do not originate from illicit sources without revealing their complete transaction histories. Users can generate zero-knowledge proofs demonstrating their withdrawals are associated with approved sets of past deposits. The paper argues that the protocol is adaptable enough to satisfy different global regulations by letting users customize their association set disclosures. The paper also discusses the cryptography of nullifiers that can obscure coin transfers and states that zero-knowledge proof contains inputs to validate transactions by revealing the nullifiers. The introduction of Privacy Pools is significant. Buterin is leading the charge to reconcile the often conflicting worlds of privacy and regulation. This is a practical solution aimed at real-world problems. The use of zero-knowledge proofs, or ZK proofs, allows for a nuanced approach to compliance, one that respects individual privacy while still adhering to legal requirements. But let's not overlook the implications here. This isn't just about making Ethereum transactions more private. It's about setting a precedent for how cryptocurrencies can operate within the bounds of the law. And who better to lead this charge than Buterin, a figure who has long advocated for regulatory clarity in cryptocurrencies while maintaining personal privacy. The paper even goes so far as to suggest that this technology could be applied to decentralized exchanges and lending protocols, further integrating crypto into the regulated financial ecosystem. From privacy protocols to legal tussles, we turn to a lawsuit that's sending shockwaves through the crypto lending space. You won't want to miss this, so make sure you're following for the latest updates. Genesis Global Capital filed lawsuits against Digital Currency Group and Digital Currency Group International. The lawsuits aim to recover multiple loans totaling over $600 million. DCG borrowed up to $500 million across 4 different loans from Genesis in 2022. DCGI took out a loan of 18,697.7 Bitcoin in 2019. Both companies entered into a master loan agreement last year, with maturity dates set for May 2023. Genesis claims that DCG and DCGI are, quote, wrongfully in possession of property that belongs to the bankruptcy estate. DCG expressed a desire to convert these into open loans, a move that Genesis did not agree to. Currently, DCG owes Genesis $500 million, and DCGI owes about $117 million worth of Bitcoin. Genesis is also seeking late fees and accrued interest. The lawsuit does a good job of casting a glaring spotlight on the shaking financial practices within major crypto companies. Genesis, once a leading name in the crypto lending arena, is now bankrupt. Its parent company, DCG, seems to be evading massive debts. This situation raises questions about the stability and integrity of significant players in the crypto industry. If DCG, a key entity in this ecosystem, fails to honor its debts, That casts a shadow of doubt on the financial health of the entire sector. This case also reveals a concerning lack of transparency and accountability in crypto transactions and agreements. It's a stark reminder that the crypto world is not immune to the financial missteps and ethical lapses that haunt traditional finance. This story has the potential to erode trust and invite regulatory scrutiny. As Genesis and DCG proceed to court, the implications could be extensive, affecting not just these two companies, but the broader crypto landscape. So what happened? Chris Larsen didn't mince words criticizing the SEC's approach to crypto regulation. He warned that the US is falling behind in the blockchain race, pushed by a hostile regulatory environment. ARK Invest and 21 Shares are attempting to launch the first US spot Ether ETF. This could be a watershed moment, but it's up against an SEC that's been less than welcoming to crypto spot ETFs. The FASB has decided to switch gears on accounting for crypto assets. Now companies can show the fair market value of their holdings, a rule change that could bring more institutional players into the crypto arena. Visa teamed up with Solana to facilitate cross-border payments, a move that could significantly boost stablecoin adoption and push the boundaries between traditional and decentralized finance. Vitalik Buterin is back in the headlines, this time with a new privacy protocol. Privacy pools could provide a blueprint for balancing privacy with regulatory compliance. A massive lawsuit between Genesis and DCG could have far-reaching implications. It's a wake-up call on transparency and accountability that could invite regulatory scrutiny. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.